Welcome to PhillipCapital's Weekly Market Watch. With the financial outlook looking gloomy, there has been talk about financial grief cycle. How does it apply to the financial markets? Mr. Dexter Tan, investment analyst from Phillip Securities, shares with us. Dexter, there's been some mention of the grief cycle recently in the media. What is that?
Elizabeth Kluger-Ross had written a book about terminally ill patients in 1969. In the book, she laid out 5 stages a patient has to go through when facing a difficult period. They are denial, anger, bargaining, depression, and acceptance. Many competitors have taken the model and applied it to investor psychology in the current bear market.
So, care to explain on the 5 stages?
Okay, the current bear market starts in a state of shock. So in 2007, we saw that people were shocked at there were loopholes in the securitization model, and hedge funds which invested in CDOs started to go under, and there was systemic risk to the system. The next stage is denial. So even though there was systemic risk to the system, the stock market brushed away the problem, and we ended the year higher even though there was risk. And then the next stage will be anger. So right now we're seeing anger whereby people are angry at executives at bailout companies, whereby even though they're receiving taxpayers' monies, but they're still paying their executives bonuses. And the next stage will be bargaining, whereby we have the Fed trying to bargain with the market, saying that what they're doing is essentially good for the system, and they're creating lending facilities and creating stimulus packages to get the economy going. So that's essentially bargaining. And the last 2 stages are essentially depression and acceptance, which are self-explanatory.
Which stage do you think the market is at?
I think we are at the bargaining to anger stage. You can see that people are angry at how the taxpayers' money is being managed, and the Fed is also doing a lot of things to help the economy, so there's exactly bargaining. So we might move in between anger and bargaining before moving into depression, and then finally into acceptance. So we haven't really seen the depression stage yet. But then again, Ross did mention that a person may also just experience at least 2 of the 5 stages. So it is still possible that we skip depression and then come finally into acceptance stage, which is the last stage.
What do you like in this market?
Last week we saw a surge in housing starts numbers, and there was financial counters have also started to move up. And you can see that the equity market has been rallying for like almost 2 weeks. And you can see that there's a lot of euphoric sentiment in the equity market. So this is likely to continue, and it might consolidate in the near term. This week, I will be looking at a pair trade. I will be looking at going long on silver as well as on the 30-year treasury bond. So if you look at last week's reaction after the FOMC meeting, silver has gone up as well as 30-year bonds have also gone up. This is because the Fed is intending to purchase treasuries over the next 6 months, and this is likely to support the market, and the Fed is also wanting to keep mortgage rates low. So this is also another argument for the 30-year bond. And but then again, all this purchasing will only create more liquidity in the market, which would bring into question the value of the US dollar. So by going long on silver will also help to mitigate the effect of the devaluation of the US dollar.
Thank you, Dexter, for your time. That's all we have for you today. Tune in next week for more market updates.